Hey traders, this is Blake Morrow with Trader Summit, and the highly anticipated weekly interview with Jim Welsh of Macro Tides is happening right now. So give him a thumbs up, subscribe to the channel so you don't miss any of these weekly videos. Jim, how are you? Good to see you.
I'm doing good, Blake. Hope you're doing good too. It's kind of been a boring week, but I'm still ready for the weekend.
Yeah, nothing's happened this week. Jokes aside, and trying to get everybody excited here. Lots did happen this week, and we've seen some major volatility. I think the volatility that you really got was in the bond market, and you've seen the bond market yields ripping up and down and up and down, and headlines are driving this market. What are your thoughts? Just taking a step back. I know we're going to go through your charts and some of the things that you want to talk about with central banks and everything else, but taking a step back, what's your general feeling of the week?
Well, again, this is a banking problem. There's a run on a bank that then is now beginning to spread. The interesting thing is I think people have jumped to the conclusion that this is the Fed's problem. And yet when we look at, okay, how have they tried to address this problem? It's through the FDIC, a consortium of banks putting money into First Republic. So it's, in a sense, the response by the policymakers so far has been, let's see if we can contain it with these other measures without, in a sense, bringing the Fed into play. Now, at the same time, borrowings at the discount window, I think, were 150 some billion. That's more than what took place, I think, in 2008. So there's a shock wave that is going through the financial system. And whenever that happens, it is a crisis confidence. And whether or not they can convince enough people to stop taking money out of various banks, that's the biggest question mark. And if they succeed, then I think there will be the willingness of Wall Street to develop another bullish scenario. But the real risk is these things have a life of their own. And so getting below some certain levels that we'll talk about in the S&P and so forth, I think you just have to be very, very risk management orientated to deal with this kind of a situation. The bull scenario will arise from a standpoint of, okay, they contain this thing. It's a regional bank issue. It's not, quote unquote, systemic. But the logic then will be, oh, this is great because this will force the Fed, whether or not they go 25 or 0 next week is almost beside the point. I'm in the 25 camp, and we'll talk about why. But the idea being is that, okay, this puts a lid on how much more the Fed's going to do. And it increases the odds that the Fed will, in fact, ultimately cut rates late this year. And in the near term, Blake, I don't think what's happening this week, we see it in the financial markets, and those of us who are close and in the financial markets, it's like, wow. But the average person going to work, they're oblivious to some of this stuff. So the impact on the economy, I think, is somewhat negligible. So I think you have the scenario where, oh, we've stopped the Fed from doing too much. Near term, the economy continues to look okay. That's the perfect scenario for the no landing crowd, where we're not going into a recession. Earnings are going to be okay. The Fed has had their hands tied, and there's a good justification. And treasury yields have come down. Inflation is going to continue to come down rapidly, which buttresses this whole argument. So to me, this is what I'm trying to deal with is, hey, on one hand, you've got some serious risk to the downside that could be triggered. On the other hand, if that is contained, there's going to be a bullish scenario that Wall Street will want to spin based on these factors. Ultimately, to me, there's another shoe out there. The economy is going to slow materially, not because of this event as much as because of all the prior moves that the Fed made, the drag that's going to hit, as we've talked, leading economic indicators, inverted yield curve, banks tightening lender stands. Well, they tightened a lot in the third and fourth quarter. What do you think they're doing now? And, I'm sure they did it in the first quarter and in the second. So historically, all the things that have been, to me, the best indicators of a coming recession, they're already flashing red, even before this banking thing showed up. So we're in a treacherous environment, and volatility is just going to remain high because you said it's a news-driven environment.
It is, and I have to imagine, one thing about Americans and America just in general is America is run by a lot of small businesses. And these business leaders, small business leaders, they really stay up on the economy. They know what's happening. They're not oblivious to this. And so it's going to be really important from the Fed's point of view, I'm sure, is to make sure this does not spiral out of control, because you're going to see the economy really slow to running at a negative pace in a very short fashion, if not the case. Is that
I mean, I think it comes down to, again, to me, what this amplifies is people's antennas get raised.
Yep.
And they're going to be more sensitive and responsive to signs of slowing. Now, I don't think near term the average consumer is going to change their behavior very much. Obviously, those involved with the individual banks are going to have a change. People, very wealthy people, maybe in the financial markets, are going to react. But on balance, I don't think we're going to get a knee-jerk pullback, because the average person isn't really that tuned in. But you go down 60 days from now, and people, like you say, small business owners who are more tuned to the economy, they start to see slowing. They may react more quickly than they would have done previously. And so you get almost then a self-fulfilling prophecy. So my point is, if this gets somewhat contained and resolved, we're going to see the equity market have a pretty good pop to the upside. And then I think it's going to get hammered.
Yeah.
So to me, it's like, you got to
keep your head on fire. Yeah, you got to keep your head on a swivel here, right?
Yeah, because again, in the overall framework, at least from my perspective, is the strength from last year in the economy is going to continue into the first part of this year as we get deeper in mid-year and beyond. In my opinion, the die was already cast that we're going to see a significant slowing, at least 1 quarter of negative GDP. I think the odds are in favor of a recession. That, to me, is already in tow. So, but again, coming into the first part of this year, a lot of people who thought we were in a recession last summer, and then the way this year started off, now we got the no landing scenario. And I think that has legs as long as it's not a financial crisis. And again, people are going to look at it, this stays the Fed's hand. Maybe they will be forced to raise or lower rates later this year. Inflation's coming down, and we're not going to have a recession. Boy, that's a pretty bullish scenario. So, but again, I think it sets you up for, oh my goodness, I guess we are going to go into recession.
Yeah.
And that's why, it's going to be a very demanding time to try to stay, if not one step ahead of the markets, not 2 steps behind.
Well, let's go into some of these charts you brought in. As you brought up your first chart, this is the tick chart to terminal. I'm just kidding about tick chart. It is not a tick chart, but you can see by the way that it moved and expectations of the terminal rate, it moved quite aggressively. So tell us a little bit about this.
Yeah. Well, again, we talked last week that basically Wall Street for months and months doubting that the Fed was going to follow through. All of a sudden, oh my God, not only are they going to follow through, they're going to keep going. The December dot plot headed at 5.1. And, to me, the Fed was always going to raise by 25 basis points at this meeting next week. But Wall Street went even beyond that. Then given the banking stuff, you can see how much the Fed funds has come down. And it's kind of like, okay, they raise one more time and they're done. And the curve shows that they're already pricing in 1 or 2 easings before the end of this year. The 2-year Treasury on February 2nd, I think it was 4.04%. Then it went above 5%, and then it's back down. It got below 4% in the last couple of days. I think it got down to 3.86 or something. Might be around 4% today. I mean, you alluded to it. The extraordinary volatility in the interest rate market is just amazing. So
some big moves on the front end. Holy cow.
Now, here's the other thing, an adjunct to what I was saying earlier. Let's say they contain this thing. Okay, is the market going to rally? Yeah. But what's the Fed going to look like in terms of, all right, this thing has been contained, not going to become systemic. The economy is going to continue to be okay.
Right.
The Fed isn't backing off. So to me, you're going to have a big celebration potentially. And then the wake-up call is, well, wait a second, we dodged that bullet, but now there's this other bullet that's coming potentially with, the Fed back in play, just at a time when I think the economy is going to show more material signs of slowing as we get closer to mid-year and beyond.
Yeah.
So, but this just shows the emotional aspect. Too bad this chart didn't go back another 2 weeks into the first part of February to see that, the shot up.
That extreme slant from left to right higher.
Yeah.
Interesting.
I mean, this is obviously amazing.
Well, what are we going to do with gold here? Because gold finally looks like it's starting to perk up. Is this perking up because of risk aversion? Is it perking up because yields? What's the driving force here?
All of the above, and the idea also that the Fed won't be as aggressive or be able to be as aggressive. From a technical standpoint, you can see I've had this chart this way for a while. From the lows last October, 1, 2, 3, 4, 5 to that 1 at the top up there. You're so good with your circling.
I'm getting it right now. Right.
And then
here.
the pullback. Yep. And so to me, back at the turn of the year, I'm like, okay, we're at an interesting juncture in terms of, did we finish the correction that began in August of 2020 when the gold got to 2070? It then dropped significantly into March of 21 and then up to a high this past March to 2067. And then it got down to about 1600. It's like a big ABC. And what that implied is you're beginning a new advance. And then that followed a 5-wave move up. This pullback I've got labeled as wave 2. And potentially what we're seeing is the beginning of wave 3 on gold. And it's going to take it to new all-time highs. Now, you can kind of see, I didn't have time to put the little numbers on, but just above the 2, you can see a 1 up, then a pullback to a higher low, then a high to 2 days ago. For 3, a little dip, and now we've had 5. And the last time I checked, this is cash gold. It was above 1659. It was like 1960, pardon me. So to me, all along, it was like, gosh, if you get above the high of wave 1, that really starts to increase the probability that gold is on its way higher. That's simple.
Wow. Okay, well, that's
now, if you got 5 up here, you may get a pullback for a wave 2 of 3, and then it really takes off.
Then it moves higher. Okay, so I'm trying to do better with the drawing. You got the next chart that you brought is gold, because what's that going to do to gold? Because I mean, gold and dollar have such a strong inverse relationship. Yes. Does that mean that the dollar is going to roll over?
Well, there I think you can get a flight to quality because you got 5 up from that recent low. This pullback, can you see an A? Like the low we saw 2 days ago was maybe wave A. You got the sharp 1 day up for B. So we take out that little where you have the little curve there to finish off an ABC. I think the decent chance, as long as it holds above, like I say, 101.90, that dollar is going to rally above 105.88. And I think a flight to safety. We've seen, concern about European banks in the March macro tides. I talked about housing prices, in the U.S., and we know how much they've gone here. But in places like New Zealand and Australia and 2 or 3 other countries, they're up like 250% after inflation since 2000. We were up 80. So we know how crazy real estate seems in a lot of parts in the U.S., in New Zealand and a number of other countries. And as it turns out, New Zealand and these countries that have, like England, they're 120%, 50% more than us. They're really relying on adjustable rate mortgages, which we all remember from 2006 and 2007, and especially 2008. So to me, Blake, potentially what's starting to happen is cracks are forming in a number of key areas. And so I think there's the potential that you have some banking issues outside the U.S., and that's what would drive a flight to quality to the U.S. dollar.
And Jim, I just want to, you brought up a great point about adjustable rate mortgages. I mean, they've actually over the last year here in the U.S., they've become more commonplace.
A little bit, but the terms are much more stringent. The quality of the loans, I mean, back in 2005 and 6 and 7, they called them liar loans.
Yeah.
I mean, you had hairdressers owning 3 and 4 properties. Because you need to write down you're making $120,000 to get this loan. Negative amortization loans, where don't worry, if you can't make the payment, we just add it to the back end. I mean, the lending that was done prior to our housing crisis was just absolutely stupid. And then the banks securitized it, and some banks held onto those paper, leveraging those loans 30-1. We don't have any of that kind of stuff going on today in the U.S. In fact, I think back in 2007, about 20% of our mortgage loans had the highest, like 760 FICO score.
Yeah.
Well, last year it was over 60% of them. So yeah, it may have upticked, but it's upticking from a low percentage. But my point is, you have the most highly priced areas around the world that have created adjustable rate mortgages at a time where obviously central banks all over the world are raising interest rates. And as those things adjust, there's going to be some real pain, and I think some problems.
Let's all move to Japan. They ain't raising rates, or are they? All right, let's continue on, Jim.
Okay.
Here's the TLT. What do you, and by the way, great call a couple of weeks ago, getting long TLT. Everybody's talking about it this week. You've been on it for the last couple of weeks. So tell us about what you're seeing now.
Yeah, it was just, 2 weeks ago, it was like, okay, you got an ABC from the high back in early December at 109.68. That projected that we would see a rally above 109.68. Got pretty close a week ago, but I think we're going to see TLT push above 109.68. How much higher? I have no idea. I really don't. You can make some calls up to 117 because it rallied from about 91 to 109. So you add 18 points onto that 98, then you're at the 115, 117, where the two legs are equal. I don't have it on this chart, but as you might remember, in October, TLT got down to just under 92. So if the rally to 109,
theoretically, just on a range like extension of this move here, I mean, you are talking about 117, 118, something like that.
Yeah. Now, if that happens, then I think that would suggest, I think we're the contained of the regional banking crisis maybe isn't contained.
Jim, when you see some of the shorter end, like this week, it almost felt like a year this week.
Yeah, it feels like it.
Like the 2 year dropping, 20 some odd percent in the week and then holding. Right. I mean, that really suggests that
extraordinary.
The short end, but that really suggests that you could see further strength in bonds.
Yes. Again, this pattern kind of tilted. I mean, I said I thought we were going to see a rally above 109.68 because this was an ABC correction. And, the way things have evolved, I didn't go so far as to come up with this 117. I mean, I did in my head because, it went from 92 to 109. That's 17 plus. You add it to 17 plus to the 98.88, and it's easy target. Then it's just a big ABC. Now, that longer term pattern, and we've talked about this, that the low in October was the bottom of wave 3. And this is a wave 4. And when this wave 4 is done, yields are going to go back above where they were in October. In other words, the 10-year above 433. Imagine what will happen in the markets if that happens.
I can't. I don't want to, and I'm just not listening anymore. All right, Jim. So let's move it on to your last chart here. Yep. What would that do to the SPOOs? Because you've been looking for a rally in the SPOOs, and I know you mapped it out for us a little bit. That hey, if the banking situation's under control,
always a wild card.
You might get a rally here, but are you seeing anything different now?
Not really. I mean, what we see from that low of 38.09, it's 3 waves up, A, B, C. So my take was in the Monday weekly technical review is I have an indicator when it gets really deeply oversold. You typically get a bounce, and then that indicator will back up. Then the S&P typically will take out the price low while that indicator hits a higher high. It's classic technical analysis looking for positive divergences relative to a new low in price. So my expectation was I think there's the potential that we will see the S&P drop below 38.09. And then again, we're in a very volatile period. If they contain the regional banking crisis, then all of a sudden, and Wall Street's able to come up with this scenario, the Fed's not raising rates much. They may cut. We're not going to have a recession, and inflation's coming down. Then a rally above 41.95 is entirely possible. My belief was, if and when that happens, that will be a great selling opportunity. So, in this kind of environment, it's great to say, well, I think this is going to happen, unless you have a plan B. all along and kind of know, all right, here's the benchmark. So to me, you close below that 3808.
Yeah, 3809.
And you don't recover quickly, watch out.
Yeah,
it's going to get ugly.
And as you've been pointing out, Jim, this is a really hard environment to understand. And when people make calls like, oh yeah, we're going to 4,200, and they don't have that plan B you're talking about, they're simply like trying to make a name for themselves. You really like to map out the risk versus reward. And I think that's why people here at Trader Summit really enjoy your work. So Jim, I want to thank you for being with us. And how do we find out more about what you do every day?
Macrotides.com, or send me an email, Jim Welsh Macro. And if you do that, I'll be happy to send a recent publication out to you. And yeah, we're in interesting times. And this is where I think technical analysis can help. As I noted in Monday's report, technically, the dollar looked like it was going to have a pullback. Gold looked like it was going to rally. Treasury looks like they were going to drop. And interestingly enough, I thought the market would have this bounce. The Qs are up for the week, 4 days in a row. They may break it today. Why? Because yields came down. So you have simple-minded thinking. Oh, Treasury yields are down. That's great for the mega cap stocks. So it's interesting how before the financial crisis showed up, that's what was in the charts. So it underscores why I am such a believer that you have to obviously be tuned into fundamentals, but technical stuff provides a different perspective and an angle that at times can be just critical and very, very helpful. So we do that every week. So that's cool.
We do, and you do. And I want to say thank you, Jim, for spending your time with us. We appreciate you. Show Jim your appreciation. Give him a thumbs up. Comment down below. He'll address those comments when he can. I want to thank you, Jim. I'm going to see you next week.
You got it, buddy. Have a wonderful weekend, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.